Hello friends, how are you all? Yes students, today this is our investment properties video number 8, okay? Today is our 8th video and in the previous video, we completed around 8 concepts. The 8th concept we covered was on transfers. That topic is completed, so today's video we are going to start with concept number 9. So everyone make a heading on a fresh page. Then I will start the discussion on this. Today we will do concept number 9. And this is derecognition of investment property. And its simple meaning is disposal of investment property when we see initial recognition of any property. Initial recognition, yes. So that means to purchase and recording the property in the books. But when we talk about derecognition, so derecognition simply means removing the property from the books, which can only happen through a sale. In simple language, initial means purchase and derecognition means sale. It's sale and purchase. And you see, we are currently at concept number 9. You must be thinking, we've studied so many concepts. What was it all about? Concept number 1. I have explained the meaning of IP to you. Concept number 2 is told out of scope, that which properties doesn't lie in the scope of Ind AS 40. Concept 3 explained the relation between 40 and 116. Concept 4, various issues were explained. It has 4-5 cases related to mixed property. Then concept 5 was taught initial recognition. In this we talk about the purchase. Cash, exchange, self-construction, deferred credit, finance lease were discussed in this. Concept number 6 is about subsequent recognition. Repair and replacement. 7th was about measurement. Depreciation, impairment, loss, don't take fair value model or take it in notes to accounts. And then I explained the 8th concept to you about transfers. I have explained these 8 cases to you. Today we are starting the 9th concept. Today we are on 9th concept, and what is the 9th concept? Derecognition, disposal. And let me tell you something fun. When I talk about the sale, then your same old knowledge will click in your mind, right? You will think that sales are very easy. In sale, only one entry is to be passed: bank account debit, NSP, net selling price minus brokerage. What did you get after cutting expenses? To investment property, here is carrying amount means book value, and any difference will be included in the P&L. So it will either be a loss or a profit. If your net selling price is more than book value, you will get profit. If less than loss, this entry will be passed, concept is over. So I'm not saying that your thinking is wrong or your concept is wrong. It is completely right. But this is incomplete information. When we study different forms at the time of purchasing, so during the time of selling, you need to learn about different forms. So you have to see around 3 ways to dispose of it. You need to learn about sales in 3 ways. The first form of sale is that you have all the money. The first form of sale is where you receive all the money. You have taken all the money at once. Property has been registered and you took the money. Then this entry is absolutely correct. But it could happen that you have deferred credit, sale. Some money has been received, some will be received after 1 year and some after 2 years. When you can purchase things on deferred credit, you can also sell on deferred credit, right? Third, if you can purchase anything on the finance lease, then you can also sell it on the finance lease, right? In a finance lease, if we consider the lessee as the assumed buyer, then in a finance lease, the lessor can be considered as the assumed seller. So you will have to make the sales entry in the books in 3 ways. And students, I want to tell you one thing, that I am not wasting your time. I got a WhatsApp from a student in previous batch that, sir, you have spent so much time on the investment property I saw my friend's copy and he said that they read it in 2 hours using the flowchart. It was finished in 2 lectures. They are studying exam oriented. You are wasting our time. Is this right? You need to clear CA final in once. You will become the CA once in life. You need to gain knowledge once. It will be useful for the rest of your life. The knowledge I am sharing with you about Ind AS, that will be useful to you. You are talking about the exam, helicopter view, drone view. I don't know how to do it. I am known for my detailed lectures. If a student wants to study properly, those who want to learn everything about Ind AS comes to learn from me. It's not my style to teach you everything as quickly as possible through a flowchart and get you done with it. Remember one thing, if you become a CA without gaining proper knowledge, you will be ashamed for your entire life. If someone becomes a doctor and lacks knowledge of medicine, he will be humiliated for the rest of his life. He has no prestige in society. They became engineer but don't know about screwdriver. Became a mechanical engineer but doesn't know how to tighten a nut. They will be humiliated for life. Passing the exam is important. Students don't come to me for the result. I don't teach to make you fail. I want to make you all pass. But I want you all to pass with knowledge. Why I'm saying this? Because the disposal that I'm teaching, even if you look at the notes of the best teacher's student, there will be only one entry for the disposal. They are neither discussing about the finance lease sale nor about the deferred credit sale. They don't even talk about deferred credit. There can be deferred credit on sale as well. Half-baked stories. I don't know how to teach like that. Some students like my teaching style that I have explained everything. And those who are looking for shortcuts, I don't have that. How can I give shortcut? I get such dangerous messages before the exam that say, "Sir, just tell us the top 25 questions only. And out of those 25, if only 4 is right. That's our 70-80 marks. Look, this is not the correct way to become a CA. It is not becoming a CA. No, sir, we have done the training and we are familiar with audits. We understand taxation. We want a degree. You know everything if you become a CA by taking shortcuts. But you will regret it later in your life that you lacked knowledge. We didn't learn everything. Confidence that you need to have, it comes from knowledge. That he became a chartered accountant. So your taxation and your accounts, these two pillars, should be strong and secure so that they can serve you throughout your life. One thing is, please do not compromise on direct and indirect taxes. And second, with the FR. Look, these two things are financial reporting and taxation, and a CA is known because of them. So I am requesting all the students that if you are taking classes from me and have come to study from me, then please come for a detailed study. I don't teach shortcuts because I don't know that. I really want to finish discussing investment properties within 2 lectures. I want to do that too. I can't do it. What should I do? Tell me. Please write. As per the provisions, of Ind AS 40, disposal of IP may take place. When we talk about disposal, when we talk about the sale, talk about disposal. So here we have 2 books. In the books of actual seller, in the books of Assumed seller. When we talk about the actual seller, there are two parts to it. If the collection is made in lump sum, if collection is made in installments, we call it deferred credit sales. And when we talk about deferred credit, there will be time value of money. Present value will be there and interest. Sales under finance lease. This is our unit 1. This is our unit 2. And this is our unit 3. We have written unit 1 in the heading. As this is the easiest way to do the sale. When all the money is received at once, what will the time value of money do? You simply have to pass an entry, bank account debit, to investment property. When we purchased the property, the entry was passed as investment property to cash. And today we are reversing it, cash to property. If you buy, the money will go out. If you sell, the money will come in. So you need to pass a single entry, bank account debit to property, bank, net selling price. Expenses will be deducted from selling price of brokerage commission. So what net amount came to your account? That is the net selling price. And we will remove the book value from the books. We have been studying this since the beginning, that we will compare the net selling price with your book value. Profit is when you receive more money, loss is when you receive less. If net selling price is more than book value, then it is a profit. If less than book value, then loss. And it will be done in one entry. See, if sale of property has been made on cash basis and entire amount is collected at once. From sales. Then the difference between net selling price and carrying amount What does net selling price mean? Minus selling expenses. brokerage, commission, will be transferred to profit and loss account as the loss or profit. I've started from where I left off in the previous line and I've added this in the middle for your reference. Loss or profit. On disposal, the following entry may be considered. We have one entry for this. If I have to record its journal. So I will pass an entry as bank account debit. Pass the entry bank account debit. Bank account debit. This will be the NSP. Net selling price. To investment property. This is WDV. We said book value. It's also called carrying amount, whatever you want. It's all the same. Book value, carrying amount, it's same thing. And whatever the difference is, here we will write to P&L. Here it's gain. Here we will debit the P&L. It's loss. If it's gain, it will be balancing figure. Being disposal of being disposal of property made. We sold the property. Write an example. I have the carrying amount. ₹10 lakh. I have the selling price. Let's say 14 lakh rupees. Brokerage on the selling price 1%. Pass the journal entry for the sale of assets. It's a small matter. Write down a small example. It will help you remember the concept. It helps me too, I know it. This example is not worth explaining. If I talk about the general entry, I will be pass an entry. Bank account debit. If the selling price is 14 lakh rupees, I will deduct 1%. So 13,86,000 rupees. To investment property, carrying amount is 10 lakhs. This is NSP. This is the carrying amount. Rest is profit. Being investment property derecognized. So it's a very simple, there's nothing special. We can pass one more entry. Profit on sale of IP debit. 386. To profit and loss. Being profit on sale transfer. Sometimes students think, sir, can we net off them and pass one entry instead of these two? Is it necessary to write profit on sale? Can't we write P&L directly here? Write it. If you want to write P&L directly, you can do it. Profit and loss is a nominal account. So all the income and expenses goes in the nominal form. First we opened a nominal account and then transferred it. So if you directly write P&L, what would you write there by bank? Bank account debit to sales, sell to trading and P&L, this is what we learned. There's no problem. At an advanced level, directly write PL. Write profit in the bracket, you will still get full marks. No problem. Not even 1%. In my opinion, the process of lump sum sale is done. And there was nothing in it. Right? I want to tell you about unit number 2. Create a heading. Students. Unit number 2. Sale on deferred credit. Sale on deferred credit. How will this happen? Sale on deferred credit is important. Let's assume the down payment is 4 lakh rupees. First year end, you will receive 10 lakhs. Second year end, you will get 20 lakhs. This means your gross income is 24 lakhs. When you sold the property, so the money from selling the property was not received all at once. You received the money in installments. Some money was received as down payment. Some was received at first year end and some at second year end. Money is coming in installments. The gross value is 34 lakhs, 20 and 10, 30 and 4, 34 lakh. The question is raised that, can we assume the sale value to be 34 lakhs, which is the gross collection, which is gross collection? 20 and 10 is 30 and 4 is 34. This is the gross collection. So is our selling price 34 lakhs? The answer is no. Your gross collection is 34. But in this, according to the time value of money, interest will also be included. This is not your selling price. Don't make the mistake of assuming it as selling price. It will have two components in which you have to calculate the selling price and calculate the interest component as well. What needs to be done for this? We will calculate the present value of these three amounts at the market rate, like we did at the time of purchase. when we purchase it on the credit. So interest is charged on each payment and we book interest as an expense in the P&L. So when we sell on credit, so we will take money with interest and the interest earned on it will be recorded in P&L as the income. When you make a purchase on credit, then you will book the creditor, and when you sell on credit, then you will book the debtors. They will take the money with interest and the money they will receive with interest. So there is an interest inflow which will be added to the income. What we did in purchasing, here we will do exactly the opposite. So you have to understand the whole procedure, don't you? The first step, I'm talking about the first step. And the first step is calculate the present value of cash inflows. For the down payment, the PV factor will be 1. For the first 2 years, PV factor will be done based on the rate. So the first step is to calculate the present value of the cash inflow. The second step, your present value of the cash inflow. This is your net selling price. This is your selling price. This is your selling price. And from this we will deduct the carrying amount. So there will be a profit or loss on the sale. So the carrying amount should not be subtracted from the gross amount. First calculate the present value and exclude the interest. And consider that present value as your selling price. And profit and loss will be calculated. So this is your selling price. And we will enter this. Bank account debit. Down payment. Debtors account is debit. And to investment property, remaining difference will be. Remaining difference will be profit or loss. This is carrying amount. And this is the balance outstanding. The received money is bank account debit. Remaining amount is debtors debit. Investment property, carrying amount, difference is profit or loss. Now you have an account opened in the name of debtors. Now we will take money with interest on it. The first installment payment will come now. I have reached to step number 3. Tell me what was the first step? Find the PW of cash inflow. Second step is to find profit or loss. And the third step is to do the accounting for the installments. How will we do the accounting of installment? We will pass the first entry. Debtors account, debit to interest. The market rate will be applied to the remaining outstanding balance. Due the interest. We will calculate interest on the due balance in the debtors account at the market rate. Then we will pass the entry bank account debit to debtors. Here the installment money is received. And this interest account debit to P&L. So this interest will be booked in P&L as an income. According to the time value of money, keep it in mind for purchase. And also remember for the sale. I am not telling you anything difficult, but it's there. If you receive the money in a lump sum, it will be done in single entry. And if you take money in installments, sell it on deferred credit. So you have to follow the entire process of present value, of loss or profit, and of accounting for installments. This is the concept. Do one thing. Let's write the whole concept first. Let's write the entire concept, then I will give you examples of it. If you buy something on credit, you can sell it as well. The concept of present value was there and here also. The concept of interest was there and here as well. Their interest was expense, here it's income. There were creditors, here it's debtor. Payment was made there, collection will come here, everything else is the same. If the investment property is sold on deferred credit, then the following steps. should be followed while making accounting for deferred credit sale. We have many steps here. I'm out of pages, so I'm going to the next page now. So here is my first step. Calculate present value of all designed cash inflows at market rate. So at market rate, it is correct. And recognize it as selling price for the sold property. It means that selling price should exclude interest component. So students, it means that selling price should exclude interest component. According to time value of money concept. The second step past journal entry for sale of IP. Once you know the present value, you can do sale entry. How will the sale entry be done? It is very easy. Bank account debit. If you have received a down payment, you should record that immediately. Down payment is recorded here. Its value is 1. Debtors account debit. If you want to, then debit the debtors. If you want to, then book the receivables. Selling price minus down payment. We need to keep the remaining money. To investment property. What's this? This is book value. Call it book value or WDV. Carrying amount. It's same thing. They refer same thing. And whatever the difference is, either it will be profit on sale, means balancing figure, or it will be loss on sale. Loss on sale. Write balancing figure also. Being investment property sold. Being investment property sold. Down payment taken. Money not received has been booked as receivables. The property is removed. Difference will be profit or loss. And if we find their total, means the total of these two. What is this total? This is PV of cash inflows. PV of cash inflows. According to step 1, this is first step. We have one part from PV of cash inflows as down payment and one is left. We will get it by charging interest on it. It's simple. The third step, if any student faces any problem in understanding, there is no need to worry. I will take an example and all of it will be clear. Sometimes theoretical concepts don't become clear. So take an example. It will be clear from that. Third step. Pass. Journal entries. At the time of collection of installments. So when the time comes to collect it, the installments are half yearly. Rate of interest is half yearly. If installments are quarterly designed, then rate of interest is quarterly. If installments are annual, we will take the rate annual. Whatever are the installments, we will take the same rate. I told you this before. We'll pass the first entry. For making interest due on receivables. What entry will we pass here? Receivables account debit. Receivables account debit to interest. Being interest made due, balance outstanding into market rate. In second entry, write for collection of installments. What will we do here? We will pass the entry bank account debit. To receivables, money is received. Apply interest first, then receive money after that. Being collection made. And for point C, interest income on. Then write balance sheet date. I'm talking about this interest. Now look at this carefully. This interest comes to P&L. Interest account debit to P&L. Being income recognized. These are 3 steps. Apply interest, take collection. Interest comes to P&L, write an example. First step. I know this concept took less time because I have already taught you about the purchase concept. You already know that in case of deferred, present value is calculated and how interest accounting is done. So it took less time. We have already studied this. Let's say the carrying amount is 20 lakhs. Collection received will be under this. The down payment will come as rupees 10 lakhs. At end of first year, 5 lakhs will be received. At second year's end, amount will be 15 lakhs. Market rate of interest. Means if the market rate is 10%, then 10% interest should be received on transaction. Past journal entries. With suitable workings. So the first thing you have to do here is this is known to everyone. First step is calculation of present value of cash inflows. The first column will be period. The second is of cash inflows. The third is the PV factor at a rate of 10%. Here we'll write present value. First, 0 period. What does 0 period mean? Down payment, money that comes today. Year 1, year 2. Here the cash inflow is 10 lakhs. Here is 5 lakh rupees. So here it is 15 lakhs. In the zero period, the PV factor will be 1. This will be 909 and this will be 826. This will remain 10 lakhs. Can't do anything else. Four, five, 00. 1, 2, 3, 9, 000. Total. Two, 6, 9, 3, 5, 00. This will be the present value of inflows. Also called selling price. In the second step, journal entries. Sale of IP. Bank account debit. Now tell me, how much money will you get? As down payment, many will say that in the down payment we have rupees 10 lakhs. In this, receivables debit. Tell me how much money will come in receivables? 16 lakhs, 93,500. How? As 26 lakhs 93,500 was amount. 10 lakhs are received and remaining amount is outstanding. I'll write it down. So there is no confusion. To investment property, you should check the carrying amount. Carrying amount is 20 lakhs. I will use a shortcut to P&L. We got our profit. 6 lakhs. The balancing figure is 93,500. And I can write here being sale of IP recorded. I have written this here. And then we booked sale of the investment property. Now see this balance here, this one. I will charge interest on this and receive the money, that's all. I will collect the amount by charging interest on it. I have to collect money with interest on this. Is that clear? Let's proceed. I have reached point B. At the time of collection of first installment. For when installments collected first time. Pass the first entry. Receivables account debit. To interest income. How this income will come? So 16 lakhs, 93,500 rupees. You need to take 10% of this. 16 lakhs 93,500 into 10%. So 169,350. we will get 169,350. Being interest income recorded made, due. We made this income due. 169,350. The income has been made due. Are you getting it, students? For the second entry, we will do collection. Bank account debit. 5 lakhs will be received to receivables. I don't think there's any problem. Just collect the money by charging interest. So write being collection made. Here is point C. Interest income account, debit to P&L. The income is 169,350. 169,350. Being income, transferred to P&L. Income transferred to P&L. Transfer it to the profit and loss. Interest was made due, collected and added to P&L. This was for one installment. Now we will proceed and look at point C. At the time of collection of second installment, you need to do a little calculation here. How? We booked 16,93,500 rupees. This amount was booked in first year. To this we added 1,69,350 and from this we deducted 5 lakh rupees. Debtors debit to debtors. Look here. We first added this and then we did a subtraction. What will happen? We will get the revised balance for the second year. 1,693,500. Add 1,69350 and then subtract 5 lakhs. So this will come as 13,62,850. How much is the collection? 15 lakhs. What is difference? It is 1,37,150 rupees. This will be rounded off. Means I have already rounded off and it will be 1,37,150. And if I talk about the rate, I will apply 10% rate here. So 136,285. Otherwise it is 137,150. You know, we take PV factors up to 3 decimal places. It won't tally the exact value, so you'll have to round off the last one. If I take 136,285, I won't get 15 lakhs. So I will have to round off 136,285 to 137,150. In first entry, receivables account debit 137,150. Refer debtors account to interest income 1,37,150. Being interest made due in second, bank account debit to receivables. We'll get 15 lakh rupees. Being collection made. Pass one more entry. Interest account debit to profit and loss account. Being interest recognized in P&L. These are 3 entries. The money will come here as lump sum. So the story is over in one entry, or the money will come in installments. Calculate the present value of the amount you receive in installments. Book the sale, then add interest, do the collection, and then send the interest to P&L. You have to follow this entire process. Unit 1 is done. Unit 2 is done. Create another heading, unit number 3. And this unit has assumed seller. In case of finance lease, do you know about the entry passed by lessee? The one whom you have assumed as the buyer, remember. What entry did he pass? The IP account is debited to the lessor. And this has become the lease liability. And the payment is done with the interest. Similarly, when we talk about the lessor, or when we talk about the assumed seller, then the entry will be passed here. So, the lessee account, debit to investment property. And it's receivable. We'll book this as receivable. And they will keep on charging the interest on the money. So, I explained to you clearly in class that the lease rental accounting will be handled by 116. So, I'm not talking about charging the interest because that's a matter of 116. Got it? And I will tell you that this entry which I am talking about will be passed at what value. So, tell me guys, at what value should we do the lessee account debit to property? So, the answer of this is the fair value. So, the lessor pass the entry at a fair value, okay? And its difference will be, property will be at its book value and it will be at WDV. The difference of these two would be the loss and profit on finance lease. So we'll take the fair value from lessee and we will book the lessee as receivable at fair value. We will consider the lessee as debtor at fair value. And the carrying amount which is in the books will be derecognized. So difference is profit or loss. So students, my point is that you will have to find the fair value of the investment property. So whatever will be the fair value in the market is considered as the selling price in finance lease. The difference between the fair value and the carrying amount will be your loss or profit. And what's next? So this lessee, this becomes the debtor at fair value. Now interest will be due and collection will be made. This process will keeps on going, same as deferred credit. But we'll not study that now as it is in 116. Lease rentals accounting in 116. So we can only able to make one entry, and that's sales entry at fair value. And also On what did we pass the entry in the assumed buyer's books? The present value of cash outflows. So calculate the present value of all the lease rentals you need to pay and pass that entry. But here is the fair value. And we will discuss the logic behind this in detail in 116. Because both of these books are different. So you guys might remember reading Accounting Standard 19 in Inter, in which UGRV was there. Unguaranteed residual value. Therefore, due to UGRV, the lessees and lessors books don't match. Due to which in both the books, the recognition rules are different. And so let's not discuss that right now because that's not a point. So we'll talk about it in 116. So for now, you just need to understand the rules. So it's not the right time to discuss a topic which is due for later. So if any property is assumed to be sold on finance lease, then the lessor will be assumed as assumed seller. The following entry will be considered at the time of derecognition under finance lease. So what entry will be made when we'll do the derecognition in finance lease? Derecognition under finance lease. Entry passage. Lessee account debit. This entry will be passed at fair value. Fair value of IP. To investment property. So the WDB entry will be passed, or book value, or carrying amount, write anything. All are same. Amount will be same, names are different, and whatever the difference. To P&L. Profit. P&L debit. Being IP transferred on finance lease. The accounting for lease rentals shall be done under the guidance of Ind AS 116. We'll proceed according to 116. So the installments are in deferred sale and accounting will be complete. So you will have rentals in the finance lease. The process will be same as take money with interest. But I can't show you that because 116 is dealing with this. Okay. Therefore, only one entry can be shown to you now. Sale entry in investment property. So what was the concept number of this? Concept number was, it's 9. Now let's start the concept number 10. Concept number is 10. So students, it's about disclosures. Disclosures means explanations in the notes to accounts. In Ind AS 40. Disclosures have been discussed. That what all we need to explain in the notes to the accounts. When we prepare the balance sheet, firstly we write on balance sheet is PP. So in notes to accounts, we need to explain that on the amount the PP is written on the balance sheet. How did you calculate that amount? So the detailed disclosures of that will be in the notes to the accounts. Disclosures of intangibles are in notes to accounts and balance sheet has summarized amount. So explain how did you get that amount in notes and many more things that need to be explained. So the detailed explanation of each and every amount of the balance sheet and the P&L is in notes to accounts. What are notes to accounts? It's an explanation of balance sheet, P&L, cash flow. Therefore, we also call these as an explanatory notes. So Ind AS 40 demanded 6-7 disclosures regarding investment property which you need to provide. So take the financial statement of any company. If you go through their notes, you will find a head for investment property disclosure if they have one. Any entity owns an investment property, then you'll see the disclosures. So we'll write the first disclosure and you will have to give a reconciliation statement. Okay. Reconciliation statement of what? Is that about how many investment property you had in the opening? And how many are the new purchase? And also how much you have spent on the replacements, that is renovations. And how much been sold in disposals and what's the closing balance? So opening. Addition, replacement, disposal and closing. You have to give a reconciliation statement. Reconciliation means we are reconciling the opening and closing here. What's in opening and closing and why is there a difference between two? Can be a new addition or can be a disposal or renovation. An interesting thing is reconciliation statement at cost to be given because we do not record depreciation here. We'll make a separate statement for depreciation and we'll give its reconciliation separately. It will become reconciliation statement of accumulated depreciation. So accumulated depreciation is also known as provision for depreciation in Inter. We call it as depreciation fund and also as depreciation reserve. So we'll prepare a depreciation statement of reconciliation. So opening balance, the depreciation of previous years and the new depreciation charged by us. How much depreciation charged in current year? So how much accumulation did we remove due to the sale? Because if you sell the property, so you will have to remove the accumulated depreciation balance. Property will be used and depreciation will be charged. If we sell it, will be removed. The other name for accumulated depreciation is provision for depreciation. Reason for the increase in provision is only current year's depreciation. Only reason for decrease in provision is disposal. You also remove the provision for depreciation from the property which you sell. And rest is closing balance. Will charge depreciation, provision increase. If we sell any property, its provision account will be closed and will be reduced, so you have to give these two reconciliation statements. Third disclosure. You have to explain the accounting policy. So you have to tell the accounting policy. So an accounting policy it's a declaration in written form inside notes. So we need to write down that which accounting policy we have used. That in balance sheet we use the cost model. And on notes to account disclosure we use the fair value model. Because fair value of property is shown in notes. And cost model is applied to property, the balance sheet, you need to declare the accounting policy that like this you did the accounting. So students often ask this question about this. So that a declaration must be given so that the examiner can see that you have correctly applied Ind AS 40. So the cost model in balance sheet and fair value model in notes to accounts, and also declare the accounting policy. So now point number 4. So in current year, if you have spent any money on replacements and renovation, then you have to tell that okay, that which property have you renovated and how much money have you spent on it. So now the 5th point is disposal. Profit or loss. If you have sold any property in current year, therefore profit or loss incurred on the sale of the property should be presented on a single line. 6th, you have to tell that whether the depreciation you have charged on the property is based on the SLM method or the WDV method. So you have to tell that okay, that what's your depreciation policy. And you have to tell one more thing, that how much rental you have got. And also what were your operating expenses, those of daily services, and about your net gain or loss from properties. You have to provide the complete detail including rental income, expenses and the profit. So these are 6 to 7 disclosures that you need to provide. So first let's write them all. Let's note down. So you can raise your hands. I will answer your question. All these disclosures. Do we need to remember all these disclosures? So all these disclosures which I have taught you and asked you to make reconciliations about replacement, about depreciation. So do we have to remember all of these? So all this is for your knowledge. It's not important from exam point. In exams. So till now no question has been asked from disclosures. But it's in your study material. So we have to study, but it has very less chances of coming. It's for knowledge. Let's write down all the points. So in our syllabus there are a lot of Ind AS and their disclosures, right? As per the provisions. The following disclosures. Are required to be made in notes to accounts. Following disclosures are required to be made in notes to accounts. Regarding investment property. Firstly, reconciliation statement. Should be given. For difference between opening and closing balance. This is the format of the reconciliation statement that you need to make. Reconciliation statement. For IP at cost because depreciation is calculated separately. So first we'll write opening balance in this. Then we will add additions to it. After that, we will add replacements. We will minus disposals. And this will be the closing balance. Opening balance, addition, replacement, disposals. Closing balance. You will have to give this statement. You'll have to give another disclosure. A reconciliation statement. For accumulated depreciation. Should also be required. So in notes to accounts, you have to tell depreciation. Statement showing reconciliation statement. For accumulated depreciation, here we'll write opening balance. After that, depreciation, addition in current year. Depreciation on depreciation charged in current year. And so, depreciation increase due to the charge in current year. Or if you sell an asset, as a result, the provision will be removed. Old balance of depreciation. We have charged this in the current year. So we will charge this on current year on all the properties. We'll remove from sold properties and here comes the closing balance. So these are two disclosures, and now third. You must tell the accounting policy. The entity should disclose its accounting policy. Which has been used for preparing which has been used for accounting of investment property. What's this accounting policy? Cost model for balance sheet purpose. Fair value model for notes to accounts. Write this down. We did it casually. The entity should also disclose the method of depreciation which has been applied in financial statements. You have to tell SLM, WDV, and also which method did you use? What method did you use? Reconciliation of property. Reconciliation of depreciation, state the accounting policy and also write down what you have done. Tell me about depreciation. If any property has been sold out in current year, so then profit or loss on sale of property should also be reported. If you sell a property, you have to write profit or loss, how much loss or profit you incurred. In sixth, the amount of rentals and operating expenses shall also be disclosed. Rentals minus operating expense, these are same as of day-to-day service. So if you have done any repairs or paid any property tax and also paid servant or maids, so we'll know the rent we received from property and the expenses. You have to prepare this detailed working. And finally, if any expenditure has been incurred on improvements in current year, then it will also be reported. We'll also report this. So there are 6 to 7 disclosures and we have to learn them all. So I have explained all the 10 concepts to you guys. So now in Ind AS 40 I have nothing important. Only practice questions are left. So all the questions which are left, I will explain each and every question to you guys in the next class. And Ind AS 40 will be completed. Okay, so we are done for the day. So okay, see you all students in next class.